Looking at the Vanguard S&P 500 ETF, or VOO, today's Friday, April 17th, 2026, we have a really serious dilemma on our hands. I mean, are we looking at a screaming, strong buy that's just shrugging off gravity? Or are everyday retail traders being lured into a massive, overvalued trap right before a fall?
Well, the momentum metrics definitely make it look like gravity is optional right now. But if you actually look at the mechanics of the order flow, it's telling a much darker story behind the scenes.
Yeah, there's a clear split there. Welcome to today's deep dive, everyone. Our mission today is to unpack this massive stack of real-time market data, technical charts, and analyst notes surrounding VOO.
Right, we really want to separate the actual trend direction from all the daily market noise.
Exactly. And before we jump into the numbers, if you are joining us on YouTube, make sure to like the video and subscribe to our channel. Also, it is practically compulsory to leave us your feedback in the comments. We really want to know where you think this market is heading.
And I should step in firmly here before we look at a single chart. We are analyzing data, examining market mechanics, and debating the numbers naturally today. None of this is financial advice.
Absolutely. Okay, let's establish the reality of these numbers, because the sheer scale of VOO right now is, frankly, it's messing with my head.
It's massive.
It is. We're looking at a current price of just under $652 specifically, 651.88, and that's up 1.54% intraday.
Which puts it just pennies away from its all-time high of 654.54.
Right. And the broader context here is that the underlying S&P 500 index recently smashed through that historic 7,000 level. We've watched this relentless climb from a 52-week low of roughly $467 all the way to this peak.
Yeah, and the appeal of the vehicle itself has always been that low barrier to entry. Investors get this broad market exposure with a microscopic expense ratio. It's just 0.03%.
Oh, wow, that's practically nothing.
Exactly. Combined with a dividend yield hovering between like 1.09 and 1.19%, the latest dividend payout was 1.87, which just hit accounts on March 31st. So it really functions as the ultimate set-it-and-forget-it vehicle.
But I have to challenge that idea of the whole set and forget thing, especially right now, given the volume. I mean, the assets under management, the AUM, is sitting at $1.42 trillion.
A trillion with a T.
Right. That is like the GDP of an entire country packed into one single fund. And we are seeing an average volume of over 8 million shares trading hands daily. It recently spiked to 8.3 million compared to a 10-day average of 6.69 million.
Yeah, the liquidity is insane.
So with a fund that massive breaking all-time highs, who is actually aggressively driving this bus today? Who is buying up here?
Well, the order flow and sentiment data reveal a really stark divide in who is buying and selling. You would assume a rising tide of broad market enthusiasm is lifting the entire index, right?
Yeah, that's the usual narrative.
But the data shows something else entirely. Buying pressure is wildly asymmetrical. It is concentrated almost completely in mega-cap tech. We're talking NVIDIA, Apple, Microsoft.
Because the rest of the market is just dragging along.
Basically, yeah. The underlying financials of the other 490 companies are practically irrelevant to the current buying momentum.
And when you look at the sentiment trackers, they categorize the prevailing market mood as greed or optimism. It's clearly retail investors eagerly buying the dip in tech, completely ignoring any macroeconomic or geopolitical noise.
They see a dip, they hit buy on their brokerage apps, but the analyst notes highlight a flashing yellow light in the underlying tape. It's a negative volume balance.
Wait, a negative volume balance? What does that actually mean for the trend direction?
It is one of the most critical structural warning signs you can find. It measures the relationship between price action and trading volume. Right now, the trading volume is actually heavier on the days VOO drops than on the days it hits these new all-time highs.
I want to pause on that because it feels incredibly counterintuitive. Usually, when an ETF breaks all-time highs, you expect massive, overwhelming volume pushing it up.
Right, you want to see strong conviction.
But a negative volume balance means retail is pushing the price up on lighter volume, while someone much bigger is dumping massive blocks of shares on the down days.
Exactly. That is the classic mechanism of institutional distribution. Look, large institutional players like pension funds and hedge funds, they operate on a massive scale.
I can't just log into an app and hit sell.
No, they can't. If a major fund wants to offload $1 billion of VOO to take profits, doing that all at once would crash the price and ruin their own execution. They need deep liquidity. They need eager buyers.
Ah, so they quietly distribute their shares into the retail euphoria.
Precisely. They use retail greed as an exit liquidity event.
It is literally like a casino quietly cashing out its own chips, while the tourists are still cheering at the craps table.
Mm.
The party looks fantastic from the outside, but the smart money is slowly backing away towards the exits.
Yeah, it represents a fundamental shift in ownership, from strong institutional hands to weak retail hands. The latest news and volume history indicate that while retail celebrates new highs, institutions are selling into that strength.
Okay, but if the big players are quietly distributing, why are the technical analysis charts and latest news still flashing massive, strong buy signals?
Because the algorithms are entirely momentum-driven.
Right, because looking at the daily and weekly timeframes, we have a classic golden cross on the board right now. The short-term 50-day moving average, sitting at 620.41, has comfortably crossed above the long-term 200-day moving average at 612.46.
And a golden cross functions as a powerful psychological and algorithmic trigger. Trend-following bots and high-frequency trading algorithms are programmed to execute buy orders the exact millisecond that cross happens.
So it just feeds on itself.
Exactly. It creates a self-fulfilling feedback loop. The bots detect upward momentum, they initiate buy orders, and those massive orders create the exact short-term strength they were tracking.
And technical analysts point out that immediate resistance is the all-time high of 654.54. If VOO cleanly breaks that ceiling, the next technical target is 700.
Which sounds great until you look at the downside risks.
Right. On the downside, we have key support levels sitting at 623.15, where there's a lot of accumulated volume, and then that 50-day moving average at 620.41. We also see the ANSI-D, the moving average convergence divergence, sitting at 4.33. That implies the upward trend is still in motion.
But relying solely on the ANSI-D and the golden cross ignores the internal exhaustion of the trend. The bearish signals are glaring if you look at momentum oscillators. The RSI, the relative strength index, is currently sitting at 81.70.
Right, 81.70, because anything over 70 is traditionally considered heavily overbought by technical analysts.
Exactly. It is extremely overbought.
I want to zero in on that 81.70 RSI. Think of the RSI not just as a momentum gauge, but as a heavy rubber band attached to the ETF's historical moving average.
That's a good way to visualize it.
The algorithms might be pulling that band tighter and tighter to chase the golden cross. But the physical reality of the market is that the further you stretch it, and 81 is extreme tension, the more violent the eventual snapback to the mean will be. Are retail traders walking into a technical trap here?
Well, the tension is measurable in the tape, and technical analysts are spotting geometric patterns that back up that concern. They're tracking a rise and wedge pattern on the daily charts.
The rise and wedge usually breaks downward, right?
Usually, yes. It indicates that the price is making higher highs, but the angle of ascent is narrowing. The actual force behind each successive push is getting weaker and weaker.
We can see that weakness directly in the bearish divergence between the RSI and the PPO, the percentage price oscillator. The actual price of VOO is hitting 652, making a new high, but the internal momentum indicators are making lower highs.
Exactly. The engine is losing torque even as the car coasts faster down the hill.
So when you combine the overbought RSI of nearly 82, the rising wedge pattern, and that bearish divergence, the structural integrity of the trend is really failing.
It is. And if that stretched rubber band snaps, technical analysts warn we could see a sudden, rapid retracement drop all the way down to the 600 psychological support level.
Man, a drop from 652 to 600 is a brutal haircut for anyone initiating a position today. This forces a much deeper debate between the bull and bear case.
It really does. We have to debate whether this is truly undervalued or just a massive value trap.
Right, because if the technicals are this stretched, we have to look at the financials. When we pull the income statements, the quarterly and annual reports, the balance sheets, and the cash flow data for these 500 companies, do they actually justify this level of risk?
Well, looking at the fundamentals, the price-to-earnings ratio, the PE for the S&P 500, is sitting at roughly 27.8x right now.
And in almost any historical context, paying nearly $28 for every single dollar of corporate earnings is bubble territory. I mean, we saw this in 1999 when investors paid infinite multiples for telecom infrastructure. How do we justify a 27.8 multiple today without assuming the market is completely detached from reality?
The bulls argue that the historical comparison fails to account for the unprecedented scale of the capital expenditure cycle we are currently entering. They argue a 27.8 PE is not a value trap. It is simply the new, normal cost of entry for an economic supercycle.
An AI supercycle, specifically.
Exactly. We are tracking Microsoft, Google, and Meta planning to deploy over $660 billion into AI infrastructure in 2026 alone.
I understand the scale 660 billion, but that is an astronomical, highly concentrated gamble. The entire best-case recovery scenario assumes this AI infrastructure will unlock massive productivity gains and revolutionize corporate income statements across the board.
Yes, it's heavily reliant on that execution.
If that productivity does not immediately materialize in the quarterly earnings reports, that 27.8 PE is going to look like a historic miscalculation.
But you have to remember that $660 billion is not just vanishing into a void. It becomes immediate revenue for the semiconductor sector, the energy sector, industrial infrastructure companies, all of which sit inside the S&P 500.
So one company's expense is another company's revenue.
Right. The elevated PE looks inflated today because the market is aggressively pricing in the future cash flows that this infrastructure will generate. Wall Street analysts are heavily discounting the downside risk. In fact, they point to an expected 12% growth in earnings per share for the index this year.
And the macroeconomic backdrop is definitely providing cover for that optimism. The elusive soft landing appears to have actually materialized. Labor markets are stabilizing, with unemployment expected to hold below 4.5%.
Plus, we have geopolitical tailwinds now. The latest news of a ceasefire in the Middle East is really reducing supply chain anxieties and boosting short-term outlooks.
So when you combine stabilizing macroeconomics with a $660 billion AI capital expenditure boom, you can see why the fundamental analysts are looking past those short-term technical warnings.
Oh, absolutely. When you check the ratings and signals from the major investment banks, you rarely see a sell or strong sell. Analyst ratings are overwhelmingly hold or strong buy for the medium to long term. They're projecting massive continued upside based on the resilience of corporate balance sheets.
The price targets from those institutions reflect an almost unshakable confidence. Goldman Sachs is projecting the S&P 500 will reach 7,600 by the end of 2026. That's a 13.5% upside from current levels.
And Oppenheimer has a street high target of 8,100, which is an 18% upside.
Yeah, and the Wealth Consulting Group has an even more massive long-term projection of 8,500. They are treating any potential short-term weakness like a technical pullback to 600 as a near blip on the radar.
They are entirely pricing in a flawless execution of the AI rollout and uninterrupted corporate earnings growth. But there is a glaring vulnerability in all of these projections.
Concentration risk.
Exactly. The true downside risk for retail investors lies in the ETF's very structure. VOO is market cap weighted.
This is a part of the fundamental analysis that genuinely worries me. Retail investors buy VOO because they want safety through diversification. They believe they are buying a stable, broad basket of 500 different American businesses.
But the reality of the index today is that the top 10 companies make up nearly 39% of the entire market value.
39%. It is an inverted pyramid.
It really is. When nearly 40% of the index's total movement is dictated by a handful of tech giants, you do not actually own a reflection of the broader U.S. economy. You own a massive, highly leveraged position in mega-cap technology, subsidized by 490 other companies.
So if just two of those mega caps miss an earnings call, or if there is even a slight hesitation in that $660 billion AI spending plan, the entire S&P 500 gets dragged down violently.
Exactly. The worst-case continuation lower is driven entirely by tech. The other 490 companies could have stellar quarters, flawless balance sheets, massive free cash flow, and it would not even dent the drop.
That concentration is why retail traders so often get trapped at the top. They buy into the illusion of safety through diversification, not realizing they are effectively buying a concentrated tech fund at peak valuation.
And when the institutional distribution finishes and that technical rubber band snaps, the retail investors holding the bag experience the full volatility of the tech sector, not the stability of the broader market.
Okay, let's summarize exactly where this leaves you, the investor trying to navigate this landscape. In the short-term outlook, you should absolutely be bracing for significant volatility.
The downside risks are very clear right now.
Yeah. The technical momentum is heavily overbought. With an RSI near 82, we see bearish rising wedge patterns forming on the daily charts, and the negative volume balance suggests the smart money is quietly distributing their shares into the retail buying frenzy. A violent technical pullback toward the 600 support level is a highly credible scenario in the near term.
But looking at the long-term perspective, the fundamental consensus heavily favors a continuation higher. The sheer force of corporate earnings resilience, combined with hundreds of billions of dollars in AI infrastructure investments, creates a powerful economic tailwind.
Right. If the macroeconomic environment holds steady, if unemployment stays low, and those projected 12% earnings growth rates actually materialize on the income statements, the best case recovery scenario for this ETF breaking through to 7,600 or 8,100 remains incredibly robust.
It's the ultimate battle, really. Exhausted short-term technicals versus an unprecedented long-term fundamental supercycle.
It is. And it leaves us with one final provocative thought for you to chew on as you look at your portfolio today. When 39% of this entire $1.42 trillion ETF is balanced precariously on the shoulders of just 10 mega-cap companies, you have to ask yourself,
Are you really diversified?
exactly, are you truly buying a diversified piece of the American economy today? Or are you just placing a massive, concentrated bet on whether the AI narrative holds up?
That is the trillion-dollar question.
It really is. Thank you for joining us on this deep dive into the Vanguard S&P 500 ETF. As a final reminder, today's discussion was purely an analysis of market mechanics and source material, not financial advice. Keep your eyes on the data, and we will see you next time.